So you're pretty constructive on the markets at this particular time?
We are. We recognize that valuations are a little stretched, but we remain very constructive on domestic large caps. Looking at 25 times forward earnings, we know they can look a little expensive, but if we look over the last couple of years, the earnings and even more so the stock prices have certainly rewarded investors that have stayed the course.
Stay the course with megacaps and things like that? Is that what you're alluding to?
I'm referring to large cap equities in general, but certainly mega caps have rewarded even more so. And we expect, if we look forward to earnings for 2025, mega cap earnings are expected to grow over 20% next year, broader market at 15%. So we've got some strong earnings projections ahead, and we're still leaning into that.
Where are you looking to get more positive that maybe others are missing?
I'm sorry, why do you think we're more positive than others?
No, where within the market are you looking to get more positive, where some others may be missing, things that just didn't perform that well? There's a healthy skepticism around certain sectors. What do you like that some others may not?
Yeah, well, I would certainly say there's some things we're watching. We still remain fairly positive in technology. We think technology is really at the forefront of some of these changes right now, reshaping industries. So while there's a lot of fear in that space, and we've heard some of the commentary earlier today, we remain very positive in the tech space. Certainly industrials, they're benefiting from some of that carryover effect with data centers and other points. So we remain positive there. Real estate certainly has been tough, and we're a little bit underweight in real estate, but looking to be more constructive as we're seeing some bottom clearing prices in that space.
No appetite to invest in international stocks, just stay U.S., generally speaking?
We have remained underweight international, and there's certainly pressure there, right? They look very inexpensive from a PE ratio perspective, but cheap isn't a catalyst. And what we're looking for is some indication that earnings are going to improve internationally before we want to step up that. And we're even more underweight emerging markets.
Why overweight consumer staples, which I see in the notes is one of your calls here?
Yeah, it's really a little bit of a hedge, if you will. We recognize we're overweight some of the more cyclical, higher beta sectors, such as the tech and industrials. And so in a way, it's not our base case, but it's a little bit of a hedge against any weakness that we could see.
You have a bit of a contrarian take on a couple of hot areas of the market. Number one is you say you've trimmed your alternatives exposure. I haven't had anybody come on and say I've trimmed my alternatives exposure. I'm leaning into my alternatives exposure. I don't have enough. Why are you trimming here?
Well, part of the reason we're trimming is to make way for fixed income. We believe that bonds have earned their way back into portfolios. You know, we've seen the yields on the ag at 5%. We really added to alternatives over the last 5 years as a placeholder for bonds, in the sense that interest rates were low. We knew they were going to be rising. We didn't want to get hit with that headwind on our fixed income side. So we used alternatives in the form of some real estate, some private credit, some real assets to try to hedge some of that risk in fixed income. And now, as fixed income yields are looking better, we needed a source of funds to add back into normalize or stabilize what would be our more normal allocation towards bonds.
I haven't had anybody in the same light, speaking of alternatives, come on and suggest that private credit isn't a good place to be. And I haven't had anybody suggest that private credit is nearing an end in any way. In fact, they suggest continually that we're only in the early innings. But that's an area that you're likely to trim as well. Do you think there are too many dollars there?
Yeah, that's exactly our concern. We're seeing a tremendous amount of inflow into that space, and we recognize from the broader perspective, right? Banks want to strengthen their balance sheet. They're being more conservative. There's the need for credit. Private credit is filling that gap. But we've seen so many dollars rushing into that space that we think that could force some compromises in terms of quality. And so it's not that we think that there's an imminent problem in that space, but there's illiquidity constraints, and we'd rather be out a little early than a little late.